Corporate Finance Core, Topic 8, Strategic Finance. Learning objective number 3. We're going to understand the advantages and disadvantages of stock repurchases, also called stock buybacks. So let's talk about stock repurchases. Instead of paying a dividend or in reinvesting earnings in CapEx and working capital, public companies often use cash to repurchase its own stock, also called buying back its own stock. And these are often mature companies that are generating positive operating profits and require very little reinvestment. So they're generating lots of free cash flows. So how do they buy back their own stock? Well, they can just do open market purchase. Just like if you're buying a stock using your E-Trade account, they could just buy shares at an exchange or with their broker, like any other investor. They could do a tender offer. A tender offer is you offer to all shareholders an offer to buy back some of their shares at some premium, maybe a 5 or 10% premium to the current price. And maybe if you get too many shareholders that agree to that, you can do some kind of lottery to figure out actually who gets it. Or you can do a targeted repurchase. So you find maybe a couple of your shareholders or maybe one large shareholder and maybe offer a deal to issue them more, to buy back some of their stock again, probably at a premium. So this is how you can buy back your own stock. Just do an open market purchase, do a tender offer to all, or a targeted repurchase to a few investors. So I want to do an example I got from the textbook, and it really sums up kind of the financial impacts of doing a repurchase versus a dividend payment. Again, think about it. Think about more of a mature company that's profitable, has positive EBIT after tax, and also does not require a lot of working capital and CapEx, so it's generating lots of cash. So you have a firm that has $300,000 extra cash that wants to give back to the shareholders. All right, doesn't have a purchase, it doesn't like the interest rates on cash, so they want to give it back to their shareholders. And let's look at a profile of that company today. Their current stock price is $30. They have 100,000 shares outstanding. So their market cap, $30 times 100,000 shares. The market value of their equity is $3 million. They have forecasted earnings for the year of $450,000. That gives them a forward EPS of $4.50 a share, which is 450,000 over that 100,000 shares. And if we just calculate their forward PE ratio, their stock price is 30 and they have a $4.50 EPS. That gives them a forward PE ratio of 6.67. So now we're going to see what happens to all these metrics if they either pay a dividend of $3 per share, $3 times 100,000 shares of 300,000, or they buy back 10,000 shares at $30, again, giving back $300,000 to the shareholders and eliminating that cash. So let's go with the dividend first. So after they pay a dividend, so think about in valuing a firm, think about the DCF model. We'll take the present value of free cash flows of the firm. We're going to subtract CapEx, add back depreciation. Now let's think about the last step. We're going to subtract net debt, which means really subtract debt, add back cash. So the fact that I can't add back the cash, that's going to make the company less valuable. The value of the company is going to fall by that $300,000. All right, so the price is going to fall from $30 down to $27. So that's the $300,000 divided by the 100,000 shares. So that's the $3. So the stock price is going to fall because they've just basically given an asset of $300,000 away. So their outstanding shares, however, are going to remain at 100,000 shares times a market cap of $27 a share. So the firm value is going to fall from $3 million to $2.7 million. The earnings per share after the dividend, well, that's going to remain at $4.50, right? Nothing's changed there. Same earnings, same number of shares. And their forward PE, it's going to actually go up because they're going to have a lower stock price, same earnings, so their forward PE is going to rise. I'm sorry, it's going to go from 6.6 to 6. It's actually going to fall. So their forward PE is going to fall because the price is going to fall. So let's think about if the firm does a 10,000 share buyback at $30. They're not paying a premium in this case. So one thing you're going to notice is the stock price is not going to change. Yes, they have $300,000 less cash, but they also have 10,000 less shares. That's going to net out to have no effect on the stock price in theory. So their outstanding shares falls to 90,000 shares. So that means their market cap is 2.7, the same as they paid a dividend, but the difference is they have less shares, so it didn't hit the stock price. And let's think about the forward EPS. Well, they still have 450,000 and they have less shares, so their EPS is going to increase by $5 a share. So again, it was 450, but the fact that they have less shares, their EPS is going to go up from 450 to 5, which would have been great when I used to work at a big bank. My bonus was determined based on EPS. I don't remember having any provisions for any stock repurchases, so I would have loved that to get a bigger bonus by simply buying back some shares. And then also the forward PE, well, it's a $30 stock price is unchanged. The EPS should go up, so the forward PE should really fall from 667 to 60 just because of the number of shares falling. However, let's think about the net effect. Relative to paying a dividend, the total value of the firm is unchanged, $2.7 million, but by doing the stock repurchase, you've actually increased your EPS and decreased your shares. Let's think about, the stock repurchase had no effect on the stock price, but it did increase the EPS. One little warning as an investor, don't be fooled by this. Now, a naive investor, they might say, hey, after the quarter is ended and the shares went down, they might see that the PE of this company fell to 6. And they might naively say, you know what, this company has always deserved a forward PE ratio of 667. So you know what, why did the valuation using that price multiple fall? I think it still should be 667. This stock is now a bargain relative to what it was. So if they just multiply the $5 EPS times the 6.67 PE ratio, they might bid up the stock to $33. So again, this is a naive investor not understanding what happened, just using price multiples to decide that, oh, it looks like this stock became a bargain. We should buy it because I think it's worth more. So I think this is a good example of thinking about why you do or the financial impacts of a stock buyback versus a dividend. And I want to talk about the advantages of repurchases because this is becoming more and more the preferred way of giving money back to the shareholders. So number one advantage of a stock repurchase, say over a dividend. One, some people say it's an offset to dilution. So dilution is issuing stock. And companies are always issuing stock to kind of attract and retain top talent through stock options. So one way to reduce the dilution of the stock issuance through stock option issuance is to repurchase the shares. I think it's a relatively minor point. Number two, stock repurchases are a signal, or could be viewed as a signal, to the market that your stock is undervalued. So why would you buy? You generally buy things when you think they're cheap, right? You don't buy things when you think they're expensive. So it's often viewed as a positive signal for your company stock if companies are doing stock repurchases. Because the last thing you'd want to do if you think your stock is overvalued is to buy more. Executive compensation. Obviously, we just showed in the last example that the stock price is unchanged by a repurchase, but goes down by a dividend. So as an executive, I want my bonus and I want my stock options to be really high. So I want to do a stock repurchase. As far as the shareholders go, a couple things going on there. And these last three items is one is for shareholders, they generally would prefer repurchases over dividends simply because of the tax code will often treat repurchases and the taxes associated with the capital gains of the stock at a lower rate. The long-term capital gain rate would be less than the dividend tax rate, which is treated as ordinary income. Next, shareholder flexibility. By paying a dividend, you're giving every shareholder money back. Well, what if some shareholders are, say, in their 50s? They're not ready to retire. They're at their stage of their life when they just want to keep the money growing and not pay any taxes on it till later when their tax rates fall. So in that case, I'd rather have the flexibility to delay my cash receipts from the company. And so I think I'd rather just choose to maybe participate in one of these repurchase programs, but I want that option. Also, just flexibility. All right, dividends are generally viewed as commitments to shareholders. In other words, if a company is paying a $5 dividend or a $3 dividend, it's considered a commitment to actually reduce that as a newsworthy event. It's kind of a view that the owners of the company are so worried they're going to reduce the dividend. So more and more companies are very reluctant to say increase a dividend, maybe make it do a one-time special dividend, because it'll be viewed when it shows next year that the dividend fell. So you have to be careful with that, the signals you're sending to the market by having your dividend go up or down. And I just want to show one chart here. It's kind of interesting chart from 2004 to 2014, and this is talking about the big market disruption in 2008 and 2009 with the real estate collapse. What we have here is the net income of U.S. companies. So you can see things are going well, and then boom, things are not going so well as we enter into a recession, and then they recover pretty quickly and things are back. Let's look at the pattern of dividends paid for U.S. companies. Not much of a change. Slight drop and then back up. Let me get rid of that scribbling. And then let's look what companies are doing with repurchases. They're repurchasing about 100 to 150 at this level. And then look at that drop. And then it goes back up. So what you see is companies are more and more using stock repurchases as a way of returning cash to investors, and then if time and holding the dividend constant, and then if times are really bad, they just reduce their dividends or even reduce their stock repurchases. So this gives you an idea of how companies are managing the return of money back to the shareholders. So in this topic, we just talked about the advantages and disadvantages of stock repurchases, aka stock buybacks.